Hello and welcome back to another week of your Mortgage Market Movers Weekly, where we are detailing everything that's going on in the macroeconomy to help you make better home buying decisions. This week's 30-year fix is sitting at a 6.22, which is slightly up from last week's 6.19. Now, last week we had the big FOMC meeting, so rate cuts. That means the interest rates are going to 2, right? No, it does not mean that, and we're going to get into everything that happened at that FOMC meeting and what it might mean for rates moving forward. So let's get on over to the charts. To the US 10-year. So now, and I get it, right? You guys are not real estate professionals. Some of you may be, but for those of you that aren't, I totally understand. You hear rate cuts and you think that rates are going down to the 2s. That is not the case, though. So the Fed did cut the federal funds rate. However, that is not what interest rates are based off of. They are based off of the US 10-year, which is why we always look at the US 10-year. Now, let's see. So that was the 10th. And the US 10-year did come down slightly, but then it bumped back up. So really not much change in the US 10-year. People are not flocking to bonds right now. And I think one of the reasons is, one of the things that the Fed has to balance is inflation with rate cuts. And when inflation is, so typically, as long as inflation doesn't get too crazy, right, Fed rate cuts are typically good for bonds. But if investors are expecting, higher levels of inflation, they're going to need a higher yield. And as we know, we always talk about, there's an inverse relationship between the bonds and the yield, of course, right? Yeah. There's a direct relationship to that. So bonds go up, yields go down, and vice versa. So, with inflation being a potential concern, the bond market was a little suspicious of the rate cuts. I think that's what it seems anyway. So we'll get into some of the economic points, but just because there's a Fed rate cut does not mean that interest rates are going to 0. Doesn't mean we're going to 2% mortgage rates. So, okay. So last week, we did have some labor data. So let's see. We had the job openings. So it looks like there were more job openings than anticipated. It also looks like, let's see. So see, federal funds rate is now at 3.75%. And I wonder. Let's see. This is. Maybe I can. Nah, I don't think I can see that. Anyway, what I was looking for was to see their statement, the statement from the Fed, discussing the current economic projections. But, Jerome Powell was what you would call. He was fairly dovish in his press conference, which dovish, if you don't know, that's more quantitative easing, so more rate cuts. Hawkish is typically when there's QT, quantitative tightening, and pausing or hiking rates. So I believe quantitative easing just started to occur, so some money's getting injected into the system. The Fed said that they are adding, I believe, some T-bills to their balance sheet, I believe. So anyway, Jerome Powell was hinting at the likelihood of continued rate cuts, and we can even go and look at, this is projections. So we're projected to get 1-2 rate cuts in 26 so far. And then in 27, I don't know, this seems a little funky. This is so far off. This is April of 27, and there's a projected double rate cut here. But one of the things, too, which the bond market might be keying off of is Powell is no longer going to be the chair in 26. I want to say in May is when his term is up. And I know that Trump suggested two specific people, Hassett and Warsh, I believe. And cutting rates too much too quick can certainly lead to more inflation. And Trump has not been too secretive with stating that he wants, lower Fed rates. So I think the bond market has a concern that should Trump nominate someone to be Fed chair, it might get a little bit more political, and Trump may be consulted for that. So that's one possible reason that the U.S. 10-year not really climbed, but hasn't really dropped too much, and that the bond market isn't really rallying off of this. So let's see. Unemployment claims 236 on Thursday of last week. That's up from previous 192. And then if we go to this week, we had a manufacturing index. This is a survey, I believe. Let's see. Yeah, surveyed manufacturers in New York State. So, manufacturing seems pretty down. Above zero is improving conditions. Below is worsening. So, negative 3.9. So, not great. Previously, it was 18.7. So, not great for manufacturing. And Tuesday, December 16th, we're getting good bit of data. Core retail sales, employment change, average hourly earnings, unemployment rate, flash manufacturing, flash services PMI. So just a good bit of information and data. Now that the last FOMC meeting is behind us, I mean, really there's an anticipated, let me go back. Oh, no. Anticipated cut, close to the beginning, April of 26. So we'll just have to see how these figures shift as we move forward. But really, as long as inflation, I think that's going to be the big thing that we want to keep an eye on is, what's inflation looking like? Is inflation coming down? If inflation doesn't seem to be too much of a threat, I think the bond market will do better. So, we want to keep our eye on things like CPI, PPI, we want to keep our eyes on PCE data, and that's what we're going to do moving forward. So, next week, this week, like I said, we have a good bit of data. Tuesday, Wednesday, not much. Just, let's see, Fed speak, which Fed speak can be important. It just depends on who's speaking and what exactly they say. I don't tend to pay too much attention to it, but it can be important for sure. Thursday, we have CPI, and this is going to be year over year. So, we're going to see, this is actually delayed data. They delayed by 8 days. Okay. So, we're going to see what the CPI data looks like. I don't know if that's going to be that big of a deal if it's already delayed data. But then we have unemployment claims, and then we have Friday. What's important for us is existing home sales. We want to see those home sales are ticking up. We also have, this is revised University of Michigan consumer sentiment. Usually the revisions don't do too much. It's the preliminary. But let's see, next week, preliminary GDP, December 23rd. And then, let's see, anything else that's crazy? Weekly employment change. Consumer confidence is usually pretty good to see. We want to see, are people spending money? Are they, I know I'm making these sounds, but dealing with a little bit of back pain today, getting old. But anyway, how much are people spending money? Are people still, comfortable with the economic landscape in order to want to dish out to buy new things, or are people just kind of hanging out on the sidelines waiting for prices to lower? We have new home sales. This is going to be tentative, but that is December 23rd. And then we have unemployment December 24th, and then it is Christmas. So that's what we're going to keep an eye on. Like I said, the 30-year fix was at 6.22, up from 6.19. But, I mean, that's really not that big of a deal. It's kind of been hovering around here. We just don't want it to creep up to like where it was at the beginning of the year. I mean, in January, rates were a good bit higher. Not quite 1% higher, but, getting there. It was getting there. That's all I got for you. So we will see you next week, and we hope everyone has a fantastic rest of their week.